Imagine a giant global machine that moves trillions of dollars every day, silently, digitally, and faster than you can blink. Most people think the stock market is gambling or pure luck. But in reality, it's one of the most structured systems ever created for building wealth. Today, I'll break it down in the simplest way possible, no jargon, no confusion. How much money exists in the world? Rough estimates suggest about $37 trillion is held in physical cash and basic savings accounts. If we include broader bank deposits, that number rises to around $215 trillion. Global real estate is valued at roughly $217 trillion. But one of the largest layers of the financial system is securities traded on stock markets, with the total value of global stocks, bonds, and derivatives often estimated around $800 trillion. This is because stock markets represent constantly changing ownership in thousands of companies, traded every day by investors around the world. The stock market solves two big problems at once. Companies need money to grow. Investors want opportunities to grow their savings. The market connects these two groups, businesses looking for capital and people looking for returns. When you invest, you're not buying random numbers on a screen. You're buying financial tools called securities. Stocks represent ownership in a company. Bonds represent loans you give to companies or governments. Instead of starting your own business, you can participate in someone else's success. Historically, investments in stocks have often delivered higher long-term returns than savings accounts. Real estate can also grow in value, but it usually requires large starting capital and ongoing management. Stocks allow you to start small and diversify easily. One of the biggest advantages of the stock market is accessibility. You don't need huge savings to begin investing. With relatively small amounts of money, you can own pieces of multiple companies across different industries and countries. Let's imagine a sneaker company called Few Step. The business wants to expand and needs funding. Instead of taking large loans, it sells shares of ownership to the public through a process called an initial public offering, or IPO. Investors buy these shares, and the company receives capital to grow. A stock exchange is like a massive digital marketplace. Companies list their securities there, and investors buy and sell them. Different exchanges exist around the world, and companies choose where to list based on visibility, regulation, and investor demand. Individual investors usually don't trade directly on exchanges. Instead, they use brokers, platforms that connect buyers and sellers. Dealers are larger institutions that trade using their own capital, helping keep the market liquid and active. Since everything is digital, special organizations track who owns which securities. Registrars maintain official ownership records for companies, while depositories keep track of individual investor accounts and holdings. Millions of trades happen daily, so accuracy is critical. Clearing organizations verify that buyers have enough money and sellers actually own the securities. They make sure every transaction is properly settled and recorded. When you press buy in your investment app, your broker sends an order to the exchange. The system waits until someone agrees to sell at your price. Once matched, the trade is confirmed, verified by clearing, and recorded by the depository, transferring ownership to you. All these participants, exchanges, brokers, depositories, and clearing houses work together to make investing fast, transparent, and relatively secure. Without this structure, global investing simply wouldn't function. Now you understand the core mechanics behind the stock market. But this is just the beginning. If you want to build real financial knowledge, subscribe, leave a comment with your biggest investing question, and let's keep learning together.